right, let's talk about moving averages now. And I love moving averages. I think they're a real powerful and yet pretty simple way to apply some technical analysis easily and quickly and really get a good visual on that. And one thing we know is that all right, let's talk about moving averages now. And I love moving averages. I think they're a real powerful and yet pretty simple way to apply some technical analysis easily and quickly and really get a good visual on that. And one thing we know is that, prices, you can probably see from all these price charts, they don't move in a nice straight line, right? And they don't move, real nicely. They are all these ups and downs and all that, and kind of, doing that. And a moving average helps to kind of smooth that out so we can kind of, a picture of what might be happening with the prices in an easier to identify manner. So in this section, we're all going to talk about moving averages and how we can apply them to our trading. So moving averages are also known as dynamic analysis. So if we think of what a moving average is, as far as just what is it, it's a key component of technical analysis for sure. I mean, it's one of the things that you see often used, often as a default on charts where you see these lines going across the chart. A lot of times those are a moving average line. Again, it's going to smooth out the pricing, so you're not going to have that choppy up and down. It's going to have a smooth kind of line. It's going to kind of smooth out those pricing depending on what moving average you use. And it can adjust for pricing outliers, right? Where you might see prices going up and down, so there's a big high and it comes down, and then there's a big low and it comes down. A moving average will smooth that out and basically account for those price outliers, either high or low. And they also work well with using them with other indicators, whether it's candlesticks or sentiment or volatility or momentum, whatever it might be. There's different types of indicators out there that we're learning about, and they pair well with moving averages, so they can be used for these other indicators. And they're very good at helping to identify trends and helping you to take certain actions around when you see something happens with a moving average indicator. What do you do next? Do you buy? Do you sell? It actually can be very, very apparent looking at these different trends and the ways that you can apply moving averages, which is what this section is all about. How can we apply that, and how can we be better traders around that? Now, a couple of things to understand about moving averages is one is they are a lagging indicator, right? They're looking at averages going back over a certain period of time that you decide how long you want to look back as far as that period of time. But it is, because it's looking backwards, it's a lagging indicator, so it's not a forecasting type tool, or a trend following tool. It's more like looking, a little bit backwards. So it's a lagging indicator that is still very helpful as far as what you might decide to do going forward, but it's not designed to look forward. So, and also you don't have to try and figure out, the start and end points of it, which is nice. When we were looking at like trend lines on, we had to figure out, well, where's the start? Where's the end? Then I got to draw my trend line. You don't have to do any of that. You don't have to do any hand-drawn trend line drawing or anything like that. It's all basically mathematical, and the trading platforms do this all automatically for you. You just set the parameters, how many days basically you want your moving average to look at, and the type of moving average you want to use, which we're going to learn about. And then it's all shown right on the chart, and then you can make decisions based on that. And so the subjective part is really just choosing that moving average you want to use and how many periods. The rest of it's mathematical and automatically done for you. So let's get into that a little bit and how that would really work. And some of the different types of moving averages that are out there, we're going to start with the simple moving average, really the most common one. So there are several different types of moving averages out there, and really the building block one is the simple moving average. It's the easiest to understand, and really the most common one that's used too. So let's look at that and how that's constructed and how we can apply that. So a simple moving average is basically looking at prices over a time period. So in this example, let's say we were looking at the price of a security over 20 days, and you can see the prices at 20 and 24 and 22, and you're going back. The most recent price would be 29 to the far right, and you go to the left, and the 10 days ago was at 20. So you do the average, where you basically, this basic math problem, right? You add up the numbers, you divide it by 10 periods. There, the average is 24.5, right? And then that's your average based on that time frame. And then on the 11th day, you now drop, your day one figure, the 20 unit, and you add in whatever the current one is, the next day's one. So on the 11th day, which let's say, for example, was 32. And you can see we now recalculate our moving average, and it becomes 25.7 would now be our average over that 10-day period. And you keep repeating the process, dropping, adding, and that gives you this range of prices, right? And that's it's a simple way of doing it. It's a simple moving average, and you're going to basically show a line, how it's going to be graphically and visually represented, showing these prices over time and how they change, going like from 24, then to 25, then it might go down or up, in this example here. And so if we look at like a chart, how this might look is, here's our candlestick price chart here. You can see our candlesticks here, and the prices, they're going up and they're going down, looking from the far left for farther back in time to the far right to the more current time frames. And so let's say we want to see a simple moving average. What would that look like if we applied it to this price chart? So what you do is you input some data so into your platform. Very easy. You just have to input, basically, one number basically, which is, you have to choose what moving average you want, and you have to input the time frame. So if we look in the upper left there, where I've inputted for a moving average or simple moving average would be 50. That would be, let's say, 50 time periods. Let's say they're days. So that would be 50 days. And I put another one on the chart in pink for a moving average over 200 days, just to show the difference between them. So if we look at our price chart now, we see a blue line and a pink line going across it there. And you can see that the blue line, the more recent look back of only 50 days, is showing where it's actually crossing over some of the prices, where some of the prices, the most recent prices, are above or below the line. And you can see if we average it out over 200 days, that never happens to cross over. Sometimes it can, it's just in this example, it's not. So if I look at this moving average, if I look at this chart now, I would say, oh, to the far left, there's not really much change. It doesn't cross the line, and then it starts crossing the line for us, the blue line, the 50-day moving average, and the 200-day moving average is just kind of off by itself. Now let's change the numbers a little bit and see how that might look a little different. So let's say I go in and I input, and I change one of my moving averages to be only 10 days as far as a look back, and the other one, the pink one, to be only 30 days. What does that look like? And as you can see here, it looks quite a bit different, right? Now both lines are crossing over at points, crossing over where the price bars are, where the candlesticks are, and sometimes they cross over each other as well. And what does that mean? And that means something. We're going to learn about how we trade on whether these are crossing prices or crossing over each other is a key indicator we're going to learn about. But for right now, just think about when I change my inputs, what does that change to my simple moving average as far as the look on it? In addition, you can see how we were using candlesticks, but sometimes people like to look at moving averages with like a line chart. And here's an example here of the 50-day moving average over a line chart where the prices are more of lines as opposed to, candlesticks. Candlesticks can tell you a lot more, but sometimes a line chart is helpful just for you to see where the crossovers happen. So it can be visually kind of pleasing in that manner. And as you saw, we can decide to have more than one moving average on a chart. Usually folks will have one, sometimes they'll have two, but you can have more on there if you want as well. That's up to you as far as how many moving averages that you want to have. And that'll be impactful as far as when we get into how to really leverage this, which is with the crossover rule, which is our next lesson, when we're going to talk about, all right, this is great. We have these lines on this chart. Now, what does that mean and what do we do with them? And that's the next lesson. The crossover rule is a very well-established rule for decision-making, whether you want to buy or sell a particular security. And it involves moving averages and when they cross over things. So moving averages, lend themselves to really easily to understand and apply this trading rule called the crossover rule. So as prices move up and down, so does the moving average move up and down as well, and it lags a little bit behind it, but when they start crossing over, that means something's happening, and we want to make decisions around what might be happening around that. So let's talk about the crossover rule and how we can use these moving averages to help us make better decisions as far as traders. And the crossover rule is actually very simple to understand. So basically when you buy, when a price crosses above the moving average, so we have our moving average line, price crosses above it, that shows that that's a buying opportunity. Same thing with selling, where the price is going below the moving average, that's a selling opportunity as far as that. So let's look at that on an actual chart and let's see, well, what does that really mean? But really kind of remember when you're buying and when you're selling. So if we look at the chart here, we can see where the moving average, the blue line, happens to be a 50-day moving average, the one I happen to select. You can select different time frames, of course. And you can see where it crosses over the price line, the line price bar chart, basically. You can see where it crosses over. And really what you're looking at is you're looking for how this interacting with the moving average. So when it crosses above the moving average line, that shows that the trend, that things might be changing, a trend might be continuing, and the prices are going to continue to rise. By the same token, when the price goes below the moving average line, then it's showing that it's going to maybe continue on that downtrend as far as staying, prices either staying or going lower, as you can see in here in this example. So basically, a simple rule would be, and they don't stay there necessarily for long periods of time. Sometimes they do, sometimes they don't. I mean, if you look at the lines to the left on the far left of the chart, you can see they're well above the blue line for quite some time before they cross below, and then you would sell, and then above and buy, and back and forth, and kind of an up and down thing in the middle there. And then to the far right, you would see where you'd buy back in again. So really, if you apply the simple rule is, if it crosses above the moving average line, I buy, and if it crosses below the moving average line, I sell, is the idea behind it. Now at this point, you might be thinking, yay, eureka! So simple. This is all I need to do. This is perfect. I just got to look at a line and whether it's going above and below the line. Okay, well, I'm glad you're happy. That's really good. Nothing's perfect, unfortunately, as far as within the technical analysis world. So don't rely on just one indicator, but it's a good, strong indicator, so you can be happy. Just don't be too overjoyous on it. So the crossover rule is really terrific. It's really easy to understand, and it's a really good, remarkably good predictable indicator, but it's not perfect. There are outliers, and you have data points that pull things far off of trend lines, and the more outliers you have, far ranges in prices, the less accurate your moving average might be, because those outliers are impacting that moving average. So it can give a false signal at times and give you a false signal of a breakout. But you can usually correct that quickly, because your moving average is going to go back down a little bit too. You probably saw in that last chart where it looked like in the middle there, where there's a lot of up and down going above and below the moving average line. So it was a lot of buy, sell, buy, sell, buy, sell. And that's a challenge, and that's what's called a whipsaw, actually. And you can get with a moving average, and one of the downsides is you can get a lot of buy and sell signals with a frequent crossing period. Where traders are trying to make up their mind: do I keep buying, do I sell, as a massive group? And you can get these frequent buy and sell things, so you're doing more trading activity, which could potentially incur more costs as you keep buying and selling. And it can occur any time, but the most common time where you see a whipsaw is in what we call a sideways market. There's no definite uptrend, no definite downtrend. It's kind of trending in this kind of narrow band, and it's going above and below the line up frequently, and that's causing this whipsawing effect of buying and selling. So it could lead to this frequent trading around that. So in the next lesson, we're going to talk about whipsaws a little bit more and how to kind of overcome that a little bit, but understand that can be a part of the crossover rule, but still a an excellent, very good rule as far as understanding when to buy and sell. So let's say we're experiencing these whipsaws with a particular moving average and a particular security we're looking at, and we want to try to reduce that a little bit. There's some things that we can do around that, and that's called we're going to talk about filtering and how to in other ways that we can overcome these whipsaws, and so you're making less trading as far as that might occur on these false signals going above and below the line, in a frequent manner. So let's take a look at that as far as overcoming whipsaws. And as I mentioned, you use filters basically to filter out, and get to valid buy and sell signals, and filter out the valid signals from the false signals. That's what you're trying to filter out, right? You want to trade based on something that's a real signal versus something that might be false. And so here's some filters that you can use around that. One is time. So the price has to, you could say, and basically have a time rule that says the price has to remain above or below a crossover point for a certain number of periods. And you can decide, 2 periods, 3, 4, whatever it might be. So you can put that in as far as timing, so you're not as frequently trading, because you've put in this rule that says, okay, I've crossed the line, but I'm still going to wait 2 days to see, to make sure we don't have a whipsaw here, is the idea of putting in a time rule or time filter. Another way you can do it is the extent, right? Looking at the price that's crossed that moving average line and say, okay, it's crossed it, that's great, but it needs to cross by a certain percentage. The price has to be either above or below the line by a certain percent, 2%, 5%, whatever the number you want it to be, as far as before I'll take action. Yes, the moving average crossing has given me an indicator. It's a strong indicator, but I don't have that whipsaw action, so I'm going to put in a rule as far as when I'm going to buy based on how far above or below the line. Also volume, as we know, volume can be a strong indicator on its own, as far as really more of a confirming indicator, confirming what's happening. So you might say, okay, for the crossover, it has to be accompanied by a significant rise in volume. Again, higher volume, higher amounts of trading is more of a confirming indicator that what you're seeing is true. So if I see a crossover with very low or decrease in volume, I might ignore it. But if I see a crossover with a lot of associated volume coming with it, then I might use that filter and invoke it and say, okay, I'm going to do that. Or you could put in something like, I want to have extreme sentiment, right? There's an uptrend and I want to really confirm that's an uptrend. So not only does the closing price have to surpass it, but the low actually of let's say a candlestick bar has to cross it too. So like the bottom of the wick, the low part of the range. So not only is the price crossed it as far as the price at the closing of a trading day, but also in the trading range, the very bottom of the wick on a candlestick, the low has to suppress it too. So I'm looking for extreme sentiment that we have crossed this price bar, and that's really a true filter, a true indicator, and we're using this filter to really make it kind of do extra work to prove that it's really true. And then a downtrend, the high would have to, the top part of the shadow, the upper shadow, the top part of the wick would have to cross under the moving average, not just close, but you're looking at the wick and you're looking for it to cross as well in that range in a candlestick too. So I've put some kind of rules around this with these filters, whether it's the time, the extent, the volume, or I'm looking for the whole trading range to cross over, not just the price, to put in more things to, make me make a buy or sell a decision, based on a trading rule in addition to the crossover to overcome these whipsaws. Now you probably are already seeing, maybe a little bit of some of the downside of filters, right? So filters will help with accuracy. You'll do less trading, but they can, and they'll help reduce whipsaw losses, as far as, again, so you're not frequently trading or trading in the wrong way. You're putting these stronger rules. But filters also increase the lag to an already lagging indicator, which can reduce profits. So if I say I'm not going to buy into something until it's, let's say, 2%, not only cross the moving average, but it's got to be 2% above the moving average. Well, now I've added another maybe indicator or added more lag to it, where I could have bought in sooner, but I want to at least make sure it's above 2%. So I just cost myself 2% in that example. So you can apply these filters based on your trading style and your feelings around risk aversion too. Somebody who has very low risk aversion, really wants to take a lot of risks or whatever, they'll have very low, if any, filters. And others are like, no, I want a little bit more of a perfect setup. And so I'm going to have maybe more than one filter, maybe another confirming indicator before I make a trade. I'll make less trades that way, but I know when I do, I'll feel a lot more confident on it. So if we look back at this chart again, you can kind of see where these whipsaws come. And you can see if I'm entering into this or I start following this particular security and I say, oh, okay, if I come in at any point and I'm above the crossover line, well, I could be buying, right? I might want to look at other indicators, look at trends, all that stuff. But right now I know, at least as far as in this case, a 50-day moving average, I've got that long stretch where I could have bought at any point of that. And if I bought at the beginning at the far left, boy, look at that nice run up I had in this security just by holding it over this period and then selling it once it came down to crossing below the moving average line. Then we enter into this period of whipsaws, right? You see the sell, buy signals again, going back and forth. We see us crossing below that last moving average line there where I have the red arrow, and you can see where we're definitely in more of a sell period or don't buy period until at the very, very end you see it kind of cross above too as well. So you can see if we filter out these whipsaws more, then we would have less of that sell, buy, sell, buy, sell, buy. but we might also miss out on its potential opportunities too. So just a way to look at it, but understand that the moving average rule by itself is a very, very good and very strong indicator. Another rule that you could use with moving average lines is I guess the moving average rule is what it's called. It's an alternative to the more popular crossover rule. So you're not looking for when it crosses over, you're basically looking for when the moving average starts to bend or change. So you would look at it to call an end to a trend when you have changes in actually the moving average line. Instead of uptrending or downtrending, it's starting to make that change either way. So if there's an uptrend, if the moving average is less than today's moving average is less than yesterday's, you could start calling an end to an uptrend with that. And the opposite, of course, would be in a downtrend. It's been downtrending if the moving average today is higher than yesterday. So you're basically your most recent data point, and then looking at your overall trend. And so the advantage of this is you're not looking at crossovers, you're just strictly looking at the moving average line over the period of time. And it helps as far as you can call an end to a trend faster than with the crossover rule. Moving averages always are a lagging indicator, but you're able to kind of see where that change is occurring on the line as opposed to waiting for crossovers and prices is what you're looking to do. It still suffers from lag, it still suffers from whipsaws, but it is an alternative, and you can use some of these filters we talked about as well to establish filters or rules around that as far as using this without the crossover of the price, but looking at when basically when the moving average itself starts making some changes. If we looked at this graphically, you could see here, you can see how it's kind of in this curve, right? It's this particular moving average. They can look different than this, but as you look along the curved line, you can see as it starts to flatten out over time, you can see that's when the moving average is starting to change. And you can see up in the upper left there what's a 50-day moving average, and the moving average is at $138.95 in this example. So when you start seeing things that are coming up less than that, then that might signal a change in that upward trend that we're generally seeing with this thing. If we start seeing that number going down, that might show a downtrend there. And as you can see, depending on the length of time here in this graphic that you choose, you have a 50-day moving average and a 200-day moving average. And of course, the longer the time period, the prices will differ too. But if you look at the curves, you can see where the top line at the far right, you might see it more of a downward trend on the far right of the blue, where the right is actually starting to trend upward, a little bit of an upward trend as they start to move towards each other. And so that's kind of giving you kind of conflicting messages, right? And that can happen. So, that time frame length can really impact that. The more time you have, the more the decision would be delayed as far as making a change. And you want to take that in consideration. And again, you can use this with other filters. You can use this with other indicators to decide what you want to do. Personally, I like the crossover rule. It's much more established, and also it just seems to be easier to comprehend and easier to see too than just But if you want to look at something where it might indicate that the trend is changing sooner, you can use this moving average and just look at the moving average itself and not really looking at the prices. So with our discussion about moving averages, we've been talking about the simple moving average, sometimes shown as SMA on a chart, the simple moving average. And but there are other moving averages that you could use as well. And so there's a weighted, exponential, adaptive. These are the main categories of moving averages beyond the simple moving average. And they work in the same manner as far as like price crossovers and all that. But let's say you want a moving average that's more reflective of the most recent price. We know a simple moving average is an equal distribution between that price range. But it could make sense where you'd be like, I'm more interested in what's happening more closer, more weighted towards more recent pricing. So, you might think, well, I'm not buying 200 days ago. That's maybe too much of a lag. I'm looking for something a little bit more, and I want to use a weighting average that might take advantage of that. Now, a couple ways you could do it. One is you could just reduce the number of days in the simple moving average. That would give more weight to something that's a 10-day simple moving average gives more weight to 1/10 versus, let's say, a 50-day moving average where it's 1/50th. So you'd have more weight towards that more recent pricing, or more weighting really with all the pricing over that time frame. But you can also use moving averages that actually intentionally put more weight on more recent days. And that's what we're going to talk about here for some of the ways that you can do that, or basically moving averages that you can choose to use if you like to do that and want to put more weight on it, which makes sense as far as doing that. So the first one we'll look at is, think of like a weighted average, right? And when we think about weighting averages, we could look at prices over, let's say, a period of time. Here's an example, just from the math standpoint. This is over 5 days. You can see the prices. The furthest back price was $20 or rupees or whatever units you're using, and the most recent one is 31, and then there's a 33 there. So you can see, the more recent prices are much higher than the ones further back. Now the simple moving average, or the simple average on that, would be 26, right? You have your 130, add them up, divided by 5. Now a weighted average would put a weighting factor towards those numbers, basically, so the ones that are most recent would have a heavier weight to them than ones that are further back. So if we look at that first bullet point there, you can see the 20, say, dollars has a weight of 1, whereas the 31 has a weight of 5. And you do the math, 31 times 5, and you can see the math there, how that breaks out. And then you're going to divide that by you're going to break that out not by the number of days, but you're going to break that out by the weights, the number of weights. So it wouldn't be 5, because that would be a simple average, or you divide it by each of those weights, 1, 2, 3, 4, 5. If it was 20, it would go up to 20 different weights. And thus, mathematically, you would actually weight the more recent time by dividing 421 divided by 15. In this case, doing the simple math part, or the math part, would show that our weighted average would be equal to 28, 28.06 to be exact. Now here's the good news. You don't have to calculate any of that when you're trading or working with your trading platform. You just have to select that you want to use a weighted moving average as opposed to the simple moving average. But I thought it was important to understand that how it kind of works mathematically, that they are putting more weight on the more recent days when you do a weighted moving average. Another one that's very popular is an exponential moving average, where it puts even more weight to recent days. So the weighting given to the most recent price is greater for a shorter term extended moving average, or EMA, than for a longer period EMA. So for example, they might apply multipliers. So if, let's say, an 18.18% multiplier is applied to the most recent price data for a 10-day exponential moving average, then for a 20-day EMA, that would be 9.52 as far as the multipliers that they're using. Again, you don't have to calculate any of this. This will all be done automatically for you, but think that simple moving average is an equal pattern, equal weighting. Weighted moving average weights the most recent days heavier. Exponential weights the most recent days even heavier still than a weighted moving average. So if we looked at this on a graph, for example, we'll take our graph we've been looking at, our chart we've been looking at, and you can see I've got the moving average over a 50-day period. That would be a simple moving average. And I have an exponential moving average of 50 on there. So it's the same time frame, but you can see how they might differ as far as, in this case, they only differ slightly in terms of the price. Sometimes, and especially if you use different time frames, it could weight it even higher. But this way you can see as far as, the different weighting, or you could use a different type of weighting around that and weighting more recent prices versus prices longer back. You can even see how they even cross over at times too. Another one is an adaptive moving average, which is kind of a push and pull aspect, where it's looking at a short time frame to identify the beginning of trends quickly, and as long as necessary, you want to kind of construct it to avoid constant buy and sell activity, or whipsaws. That's where these adaptive moving averages came in. Because with any of the other ones we talk about, you can still have that frequently trading whipsaws. So sometimes you might want to adapt it to a smaller number of days, and then sometimes to a higher number of days, but you can kind of play around with it. But you don't want to force it, because you're not sure which is right as far as the right days. So adapting moving averages uses, calculations, complex, and it's all automated calculations, to do this by detrending the series to make the current price most important. So it's not so much weighting as it's actually detrending, whether it's up or downtrend. It's actually adjusting the trend in the series of numbers is what it's doing with an adaptive moving average. So there's some complexity behind that. What you'll see on trading platforms, and probably the most popular one of this, is the Kaufman Adaptive Moving Average, or you'll see it listed probably as KMA, named after a gentleman named Perry Kaufman. And what it'll do is it'll closely follow prices when the price swings are relatively small and the noise is low, right? So it's kind of adjusting for that. And it's got a complex formula, a lot of multiple layers on it, and they actually have some recommended settings. Sometimes you can change the settings, but they have recommendations around those settings. You know, for 10 being the number of periods, 2 the number of periods for an EMA constant, and 30 the number of periods for a slower EMA constant. Those would be the traditional numbers you'd enter in, 10, 2, and 30. If you choose a Kaufman moving average in your platform, it'll actually prompt you for that. I have a link there if you want to really learn the whole math behind it. You can kind of find that out as well. So here's an image or a chart here where it's showing that the Kaufman moving average is, is looking that when prices spike there, it actually smooths it out even more, and you have that downtrend kind of coming down. And then when the prices turned up over 50%, then it really started to impact it more. I see is where it's weighting that more recent price changes versus an outlier. It's more weighting a little bit more of a longer part of that average with an adaptive measure is what it's doing. So with each of them, they all have their strengths and weaknesses. Simple moving averages would be the easiest to understand, and most commonly used. Weighted moving averages, they're weighting those most recent data. Exponential takes even more weight on them. Kaufman tries to use some more complex formulas around that, as far as, the different types of moving averages. So when you're looking at moving averages, that's one of the considerations you want to think about is which one you want to use. There's some other considerations too, which we're going to talk about in the next lesson. So many people in technical analysis love using moving averages, and they're very, very commonly used, but there's a lot of big debates around them. And one of the biggest debates around them in technical analysis is which one do you use? And they really kind of come around two big aspects of it, which is the aspects you need to choose when you're choosing to put a moving average on the chart or on the security you're looking to evaluate. And so you need to think about the type of moving average you want to use, simple or weighted or exponential or adaptive, whatever it might be. And then the length of time, the period of time, those are the two things that work together that you get to choose from. So let's talk about that a little bit more. So we think about it, what's most sensitive to recent price moves, if we were to kind of grade that. Simple moving average, or SMA, would be the least sensitive, and then weighting moving average, and then exponential, and then something like a Kaufman moving average would be more sensitive to recent price moves. So that's a way you can look at it. For one thing, how much you want to put most emphasis around recent price moves. The other would be the time frame. How long of a time frame do you choose? The shorter the time frame for your moving average, it's going to respond quicker to new conditions, right? But in a longer time frame will reduce errors, basically reducing whipsaws, right? Basically going in and out. So if you want something that responds, quickly and is very sensitive to prices, then you might use an EMA with a short time frame. If you want something that'd be less sensitive to most recent prices and over a longer period of time, then you might use a simple moving average with like a 20 or 50 or even a 200-day time frame. And they all kind of work, and they all work in their own ways. But that's the big thing you want to understand is sensitive to recent prices in choosing the moving average, and the time frame as far as how quickly they're responding. Shorter time frames, more responsive as far as that would go. Now here's the deal with moving averages. They have limitations. They're very useful, but they're not perfect. Nothing's perfect, right? But they can be used really in conjunction with other types of indicators as well, as far as a really good confirming type indicator or working as a pair. And some of these challenges, though, are harder to overcome than others. So let's take a moment to talk about some of the limitations of this. They're good, but let's talk about some of the limitations and some of the ways that we can overcome them. We talked a little bit about filters with the simple moving average. Let's talk about some other things we can look at as well. Now, one of the limitations of moving averages in general is when markets go sideways, right? There, you can almost see from the image there in the circle where it goes up and it goes down, up and down, and it's kind of going the sideways thing versus a definite upward trend or a definite downward trend. Moving averages are better that way. They struggle a little bit more when there's no trending or they're moving sideways. It makes it harder to predict the next move, and that's where our whipsaws come in, right? They're frequent price changes above and below the crossover line, giving us different, buy and sell signals constantly, so we might be, forced to trade more often unless we filter that. The value in a sideways movement is you can recognize that is to recognize that it's occurring and then adjust or wait for a trend to appear, or you can use other tools with the moving average to identify actions to take, like looking at support, resistance levels, different things of that nature. But understand that a moving average can be a little bit more limited in a more sideways market. If we look at this image here, you can see where there's a definite uptrend in the blue and a definite downtrend in the right. And then we see this sideways trend there in the middle where it kind of is bordered between the two, the top and the bottom on that. And then, using things like our chart analysis, we can identify that it's a channel, and we can sell near the tops of this channel, for example, or we could buy near the bottoms of the channel. This is our resistance and support lines that you see that we've driven over the top of it above these prices. And then if we look at the moving average overlaid on top of that, maybe we could also look at, to be even more comfortable, we could say, well, we're going to sell near the top of the channel, expecting it to come back down. And then when it comes back down, maybe we've sold at the top of the channel, but if we're not sure of the channel, we would certainly sell after it crosses that moving average line. And then as it gets more near the bottom of that support level, then we might buy near that bottom as opposed to buying, or we could wait until we bought, after it crossed the line again. So you can kind of see where, they can kind of work together, these different channels and moving averages. And there's different times when you'd be buying or selling, whether you're moving quicker on something like that or slower on something like that, depending on the channel and depending on the moving average. Another limitation dealing with moving averages is noise, right? If you have a disorderly chart, there's lots of outliers, right? So it's kind of noisy. You have spikes, or you have high prices, low prices. It doesn't seem to be really, very organized as far as a chart, or a noisy chart. It can give off more false buy and sell signals, right? It's going above and below the line, whipsawing a lot. It just seems to be all over the place. And you can fix that by applying a moving average with more days in it. So things that are these big outliers can get smoothed out more and become less of an outlier, because a longer time frame will actually smooth that out more than a shorter time frame. However, a longer time frame will increase the lag a little bit more. It doesn't put as much emphasis on more recent prices. So it's with all these things, you have kind of a give and take around that too. But if you're dealing with a chart that seems just real confusing, highs, lows, all over the place, and you want to try to get a feel for that moving average, try a longer time frame to give you a little bit another way of looking at it, understanding though that it might increase the lag. And then if we look at lag itself, that can, of course, is a limitation. And you could see a dramatic price move, and you could see potential profits. Like, look at where it went. It went way down. There might be a way to buy in, and then there might be a good opportunity here. But you're, let's say you're a disciplined investor. Hopefully you are a disciplined investor, and you decide you want to wait a few days for that lagging moving average to catch up and then actually create the crossover. So you can see it kind of happening. You see it kind of moving towards the line, the moving average line, but you're waiting for the crossover to happen, which is your way of confirming and your way of making that decision around that. And if you put an extra filter on, like it needs to cross the line by, like, say 2% or 3% before you actually make a decision, let's say to buy, for example. Meanwhile, while you're waiting for that kind of lag, you could be losing out on profits waiting for that to happen. Now, the nice thing with technical analysis, you don't have to be perfect. You don't have to be perfect every time. But understand there's an opportunity cost, where you might be delaying to avoid the whipsaw and avoid frequent trading, but you're experiencing that lag. Now, you can fix that by applying a moving average with less days in it. So it'll be more sensitive to that recent price, or you put maybe more of a weighted moving average with less days, then it's doubly sensitive to a more recent price, and so you're trying to reduce that lag a little bit as far as your trading decisions go. But if we look at some of those things, you can see the conflict. I hope you saw the conflict there right away. If not, let's talk about that. You have noise and lag, right? And noise you fix by applying a moving average with more days in it. And then lag you fix by applying a moving average with less days in it. So you kind of have to play around it, especially as you learn certain securities, what might work best for that particular security. But you can see there's a yin and yang here. You're by giving up one, you're getting more of another. So unfortunately, there's no magic number of days, right? I wish there was a magic number. I would say, well, the best number to reduce noise and lag at the same time is this number of days or number of periods, depending on could be hours or minutes, let's say, if you're a day trader. So there is no actual, perfect one. Some are, might work better than others, but there's no perfect one. You just have to adjust and understand, noise and lag. Alternatively, what you could do is just focus on a security that's more orderly, or in effect less noisy, has less of these outliers and things, so it's a little bit more orderly. So if you have less noise, you can kind of work on that lag part a little bit more and use a moving average with less days because the security is moving in a more orderly fashion. So that's another way you could do it. And then there's another option which you could use multiple moving averages as a strategy, and we're going to talk about that next here. And so we're going to talk about that strategy where you're not looking at when the price crosses over and dealing with that limitations. You're going to look at when moving averages cross over each other. So let's take a look at that here in the next lesson. Another effective strategy is not to really look at the prices really at all. You're looking at the moving averages and how having more than one moving average and how it interacts with each other. So you're looking for price crossovers. You're actually looking at moving average crossovers. So how that kind of works is you have one chart. You have your chart of your candlesticks, your prices, whatever is going on there. And you're using a moving average with different timelines. You could even have different types, or they could be the same type, but they definitely have to have different timelines as far as days, minutes, hours, whatever your time frame is. And what you're looking for is not that the price is going to cross that moving average, but that a shorter timeline moving average is going to cross a longer timeline moving average. And we'll have some graphics here that'll show that in action and what to really look for. But think conceptually like not about price, two moving average lines, and then they're crossing over themselves is the idea. And then what do? Do you buy or sell based on that crossover is the idea. And we're going to talk about that. So for example, a real common way to do it, or combination, is have a 5-day moving average and a 20-day moving average is a common combination. You can see they're shorter time frames. And as an effect, you're comparing 1 week of prices, 5 trading days, and 1 month of trading prices, or 4 weeks times 5 is 20 days as far as being open, markets being open, closed 2 days a week, open 5 days a week. So that's a common way where you're looking at a week versus a month, and are they crossing over? However, you can choose and experiment with your own timelines, and that's perfectly okay. A lot of people use 50-day versus 200-day moving averages. There's lots of different ways you can do it. But a common one to get you started is like a 5-day and 20-day moving averages. So what you do is when you buy, when the shorter time frame moving average line crosses the longer moving average line on the upside. So you've got this longer moving average line, and the shorter one is crossed above that line. So by the same token, you sell when the shorter moving average line crosses the longer moving average on the downside. So it's going down below it. So you've got the shorter one is going to go below the longer one, and then the buy, of course, when the shorter one is going above the longer one. So let's look at this graphically so it makes a little more sense to us here. So if we look at this chart here, you can see we have a 5-day moving average in the blue and a 20-day moving average in the, we'll call it pink here. And you can see, let's go over to the far left. You can see how we have a real strong uptrend here on the far left. You can see that 5-day moving average prices, again, very sensitive because it's not a long time frame. Even though it's a simple moving average, it's not a weighted moving average, but you can see how it hugs to the prices. Versus the 20-day moving average, there's a kind of a gap between that blue and that pink line on the far left. And then you see them start to come together here in the middle where it's almost hard to see, but you'll see that blue line cross, a little bit, or start to cross below that pink line. Those are sell indicators that, we might be a little bit of a downtrend or an opportunity to sell, that we've topped out, and we're actually in a more of a sideways market, and it's kind of whipsawing a little bit there. But that would be our sell signal that the blue line, the shorter time frame, is going to cross, above and go below. It's going to go below the pink line. And then as we go a little bit further on, you're going to see a definite uptrend come again where that blue line, 5-day, is going to cross that 20-day, definitely cross it and go above it, and then keep going above it, and that would be a buy sign. And then so on and so on as we go across the chart. You can see the lines crossing each other, and each time there's a cross, that means that there is either a buying time or a buying indicator or a selling indicator as you go through those. And I've highlighted those here. You can see, where there's a sell, a buy, sell, buy, sell, buy, as far as looking at those when they cross over and when they go back up again. Again, if you have longer, let's say instead of a 5-day, I was using maybe a 40-day or 50-day moving average for the pink line, there might be less times where they might be crossing. So that's where you can, adjust those to see what's comfortable for you. But this is a classic way to do it, is with a 5-day and a 20-day, and you're looking for when the lines cross over, and this has nothing to do with the prices, you're looking at just the blue line and the pink line. It should correlate a little bit together as far as with the prices, but you can kind of see you're really looking at the lines more so than prices by looking at moving average crossover versus price crossing over a moving average line. In addition, if you see more space or what you call daylight between the two lines, you'd have more confidence that the signal is correct. So if we look over in the far left, or you can see where the arrows point, and the other two areas as well, there's a lot of daylight, a lot of space in between the blue and the pink line. So that gives us a confidence that, okay, this is pretty strong. It's going to probably keep going on that uptrend there, for example, and the far left. And so we feel pretty good. Once there's less daylight, which you can see in the first cell box, it starts to get all kind of messy there, all close together. Then there's less confidence that that sell signal is correct. That's not just going to whipsaw and go back to a buy signal. And then after that second buy signal, we see another big gap come up, and so we have a nice another run up in this particular security, where we can have confidence that that signal is correct, and then so on throughout the rest of the chart. So when you're looking for things with moving average crossovers, look for the crossover, but also look for how looking back over time, how wide that gap is, how much daylight is there between the two lines to give you another extra level of confidence that you're making, the correct move on that. If we were to, let's say, lay on 3 moving averages, and let's say we wanted to have this almost be a filter where we're like, yeah, 2 crossing is good, but we want to make sure that all 3 are crossing to be really extra sure, you could do that actually. You could say, okay, I want my shortest time frame. It'll always be the shortest time frame. And let's say I've got the blue in 5 days, the pink in 20 days on this chart. And then I've added a moving average, a simple moving average of 60 days, right? So you can see to the left how there's a lot of daylight between the blue and the pink. But if you look between the blue and the pink and the green, there's a lot of daylight even between them. And you can see how if we follow that green line going up and where that blue arrow is saying approached but did not cross, you can see we go all the way across that chart for a long time frame before we actually cross all 3 lines, really somewhat significantly where we're crossing all 3 lines where the blue line is in effect crossing the pink line and the green line, those longer moving averages that are telling us a real sell signal. So if we did it this way, you can see how it takes out all that whipsawing that occurred earlier, that above and below the line, took all that out, and we've been holding the security all the way until we get to that sell part, and then we sell from there. And then as we get to the far right of the chart, we're waiting for a buy sign where it looks like on this chart, the blue line, the short time frame has crossed the pink already, but we're waiting for it to cross that green one. And once it crosses that green one, then we're looking at another buying opportunity. But right now on this chart, long time we've held this particular security, we've sold it, and then now we're kind of watching it to see if there's an opportunity using 2 moving averages crossing each other for another buy opportunity, or if we should just stay out of it. Another thought too is if your trading platform or software allows, you can even put more than 2 moving averages on there, or 3 or 4 or however you want. You can even go up as high as 10. Depends on the trading platform. A lot of them top out at 10 or at 3. But if you can allow to put a whole bunch of them on there, then you'll get kind of this colored line effect that'll kind of create like a rainbow. So your shortest time frame is going to kind of move through the rainbow, and some people like that. But again, if you put on a lot of filters, you're going to have less trading opportunity, which might be good, certainly limiting whipsaws, but you might be giving up an opportunity when maybe you should have got out sooner, or you might miss a buying opportunity on the upside. So traditionally, it's 2 moving averages, the shortest one crossing the longer one, but going 3 adds another extra layer of filtering basically on that, and gives you a little bit more confidence. And don't forget that length between a daylight here to give you more confidence too between the lines. Another powerful tool that you can use in this whole moving average kind of section here is called the Moving Average Convergence Divergence, or MACD. Moving Average Convergence Divergence, and it's really widely used. A lot of people use this. In fact, a lot of times it's a default setting on a trading platform, which will automatically just kind of show you that, and we'll have a graphic here in a second so you can kind of see what it looks like too. But that's how popular it is. And the reason it's popular is it's trying to overcome that challenge that a good disciplined investor, we want to be good disciplined investors, And we have that challenge where we're waiting for the price to cross over a moving average, for example, or another moving average to cross over another. We're waiting for this crossover rule to happen, and we can see it forming. We can see it's coming. We're hoping it's going to come, but you wish you could take action now, right? You wish, like, could I just get in a little bit earlier? Do I have to wait for the crossing? Well, yeah, you're a disciplined investor. You got to wait. But with the moving average convergence divergence measure, this gives you an opportunity. Maybe you could, get in there a little bit early or out a little bit early, depending on whether it's converging or diverging. So let's take a look at that. But that's the whole idea, is it's overcoming that challenge of waiting for the crossover to happen. So if we look at it, with crossovers, you see them merge, right? You see them coming, and you see a turning point, and they're approaching, and then when that happens, then you're looking for a new direction to occur, is the idea. And by that time that crossover occurs, it's lagging indicator, right? So the absolute peak whether it's a peak or the absolute trough or bottom has already passed. So you can't buy at the absolute low, or you can't sell at the absolute high. You're waiting for that lagging indicator to catch up and really give you a good solid answer on it. And that's a good thing about moving averages, by the way, because it gives you some good solid indication, basically. But this is where the MACD comes in again, where you're going to visually see or quantify that there's an opportunity here, and you're going to try to get in at that, either in at that trough or out at that peak a little bit more. So when we think about convergence and divergence, convergence would be coming together, right? And then when you have convergence, it indicates a trend. We're looking for trends, that a trend may be coming to an end. It's kind of an early warning signal. So we've got a trend, it could be up, it could be down, but something's happening where there's a convergence, and that's a signal that the trend is going to, come to an end here. And we'll see that graphically in a moment. A divergence, think of that as going apart, or, more daylight, it might be a way to think of it. And so the current trend is safe from a crossover or a reversal. Remember, we were looking at those ones with that more daylight. We knew, that on the far left of the graph, we had a lot of daylight, so it had to come really far to get to that moving average. We had a little bit of safety there. So divergence of more daylight or going apart, it really is an indicator that the trend is not going to reverse. If anything, it looks like the trend might be safer for a longer period of time. We will continue to ride that trend, at least for a few more periods maybe. However, normally wide divergences are not sustainable and can be a warning that prices may have started to reach an extreme. I mean, you think about it, if there's these wide price ranges, we might be really kind of approaching that peak. Or maybe we're going the opposite way, we're approaching that bottom. So it's another way that you can, where a convergence is really indicating a trend might be coming to an end. A divergence might be also a warning signal that, things could be good, but it could be a warning signal also that we might be hitting either that trough or that peak too. So we can use this MACD to kind of help us with that. So if we think about it, how it kind of is calculated is you take a long-term or a longer-term moving average prices, and they're subtracted from the short-term moving average prices, right? So it's kind of mathematical. The trading platform will do this automatically. You just choose that you want it, to indicate the MACD, and then it'll create a nice line on your chart, or it'll create some information there for you. It's created by George Appel, and he used exponential moving averages of 26 and 12 days. Although you can change the parameters if you want, but really what I see in the literature and everything, everybody's pretty solid on this 26 and 12 days, but you can adjust it. Though, most people would recommend that you stick with it and just, use what's been kind of tested and proven. So that's what we'll use here too. So if we look at our chart, here's our familiar chart again. We've got we put in a 12-day and a 26-day, simple moving averages, the blue line and the pink line, as you can see, and it moves across our prices there. But at the top, because we, automatically defaulted, we selected, these 12 and 26 periods for an MACD, you can see that you see some lines, kind of going together, a 12 and 26 line, looking at, these convergences and divergences. So let's look at what this is telling us. So if you look at the far left, when you see the lines rising, or the two averages are, basically what's happening there is the two lines are diverging. And so that means the trend is going to continue. So, diverging means trend continues, right? Though we might be peaking or troughing, a trend is going to continue. So if we look at the top of our chart here, and we see these black and red lines kind of going up there, that's the lines are rising, and that's indicating that the trend's going to continue. And if we look down, if let's say we're way back in time on this, you can see how, yes, obviously that trend was continuing in this case. Once they start to flatten out at the top, and they start flattening out, and they start coming down, then when the MACD line falls, that means the trend is ending, right? So the two averages are starting to come closer together, and they're converging, and the MACD is going to represent that to us as far as that happening. And we can see it on the main chart too. You can just start seeing those moving average lines starting to come closer together, less daylight, and they're coming closer together. It's just that the MACD is going to give you a little bit of indication of that coming, maybe ahead of time. And then we go so on and so on throughout that. One thing too is on the far right there, I said where I have a note where histogram may be easier way to visualize. If you look at that those blue bars there, the histogram sometimes can be an easy way to visualize that. You can see where you might have peaks and valleys in the blue line, and where it gets really narrow to the main line, which is 0, how MACD would be +1, -1, and up and down from there. As it approaches that, that's when they're kind of converging together. You can see how close they are together, maybe easier with the blue part than you can with like the red and the blue crossing each other. But when they cross, that histogram should be basically almost 0, basically is what it would be. So this is interesting. This is great. You're saying like, okay, but I can kind of see it on the other chart too. Where is this helping me? Well, if you look closer at it, I'm going to put on some highlights here. The real advantage of this MACD is going to tell you earlier what is happening with the trend. That was our whole idea, right? And we want to see things happening a little bit sooner than waiting for the price line to cover. And so the gold circles, show the ending in this example of an upward trend, right? There's a sell signal going on, and you can see where where there's these, let's say the lines are crossing, and when it was first going down, as the blue line starts getting down and starts to cross for a little bit and then goes back up, or it's crossing over prices, crossing below, prices are crossing below, let's say the blue line, or crossing below, the longer line. If you look at vertically straight up between these two circles, you can see that the MACD is giving you an earlier sign, a few periods ahead of that something might be up and to be aware of. So that's where people use it. As far as I'm using my pricing, my moving averages to make buy and sell decisions, but I might be using that MACD to give me an earlier warning that something's happening, and I might be able to actually act before they actually do have a crossover period. So that's the whole idea behind MACDs. Again, nothing's perfect, but that's the idea behind them, is you're trying to get an indicator ahead of time than waiting for the prices to happen as far as crossing over. In addition, you can use other indicators in combination with these to try to get confirmation that that's truly what's happening as well too. So if you see lots of blue lines, or at the top of that MACD, you can kind of get a feel for what's happening, and then it's going to indicate what's happening below in your chart too, as another way of trying to maybe get ahead of a little bit, or another thing that might indicate to you where you're looking at it and say, oh, I think a selling time is coming. Oh, my MACD is kind of confirming this a couple days ahead of time. I really want to watch that. Or maybe I want to just get out now while I can, and then we'll see from there as far as whether you're going to go back in or not. So that's how the MACD is used as an early indicator on your moving average chart, moving average crossover chart. So are there some magic moving average numbers? Like when we talk about that, we're talking about time frame. Are there some magic ones, or the right ones to use, so to speak, or some better than others? And there may be some better than others, but there's no magic moving ones. Or moving average numbers. There's no magical numbers around that, or average or special time frame numbers. Someone says they know the best numbers or whatever, you might be, or they have a great system. You might want to be a little skeptical of that. But there are some common time frame numbers that are used a lot and are talked about in the media and all that too. So you will hear these over and over again, and there's one that really kind of stands out as far as something that's very commonly talked about. So it's good to understand what's going on with those. They're not magical, but understand that they're maybe highly publicized, and then how that can actually impact our investments, our securities that we're investing in. So if we think about the one that's really talked a lot is the 20-day moving average. And the 20-day moving average stands out because 20 days equals 1 month of trading days if you look at a trading period. Now a 20-day moving average, it could be a 20-minute moving average or 20-hour moving average. Again, the time frames you can set based on your type of trading, how often you're trading. A day trader would have minutes and maybe an hour. or hours versus somebody who's like me looking more at a month of trading days. But it's well known and it's observed by the trading community, so people know the 20-day moving average, and it's almost a self-fulfilling prophecy, right? So, because everybody's talking about, oh, something's happening, it's coming close to the 20-day moving average. So when a security, let's say, is trending, it's common that the 20-day moving average will work like a support line. Sellers will stop selling it when it's reached. This is actually very common. It's like, oh, it's coming to the 20-day moving average. We don't think it's going to cross it. We think that's going to be more of a support line. So sellers will stop reaching and selling, and it'll actually intentionally bounce off the bottom of that support line and start going back up. That's actually very, pretty common. Less common is when the 20-day moving average, works like a resistance line at the top, where buyers stop buying when it's reached, where they're waiting for it, to reach at that top, and they're like, oh, I don't think it's going to cross the 20-day moving average, so I'm going to now stop buying because we're coming up a resistance level. Now, if your charting and stuff has actual resistance and support levels, that's another thing, and maybe this is reinforced. But I think there's a little bit of self-fulfilling prophecy where people just believe these things, and they're like, well, okay, I'm not gonna sell when it gets down towards the 20-day moving average, but and I'm not going to buy when it gets to the top because I think it might break through that 20-day moving average. So not a magic number, but understand this is what you might hear in the media when they start talking about a security approaching the 20-day moving average. Now there are other moving average numbers too, and other popular moving average numbers includes a 5-day, which is like 1 week of trading, and 50-day, 100-day, 200-day, and why are these popular, right? Well, they're popular because they're round numbers. They're not magic numbers in any respect. At least the 5-day, you could say, well, equals 1 trading week or something, but they're not magical in any manner. But it does give the financial news something to talk about, and maybe make up. I don't want to say make up, but talk about things that when these things interact together with these kind of popular moving averages, like the dreaded, drum roll, dreaded death cross. Have you ever heard of the death cross? It's a real thing, and I don't know if it's not a real statistical thing, but it's certainly something they talk about in the media. So a death cross is simply when the 50-day moving average crosses below the 200-day moving average. That's the definition of a death cross, right? 50-day goes below a 200-day moving average. So we would know that would be kind of like a sell type pattern or a bearish pattern. Now, there's no statistical advantage over any other crossing pattern, and actually, since it's got longer time periods of 50 and 200 days, you actually are experiencing more lag, as we know from our previous lessons. But traders recognize a death cross. The media talks about a death cross, so it might be a self-fulfilling prophecy that, oh my gosh, a death cross is happening. We need to be aware of this, that prices are about to really go down because we're going to cross this death cross, or the death cross just happened. So this is a terrible thing. Same thing with a golden cross. So the opposite is when the 50-day moving average crosses above the 200-day moving average. That means prices are going to go up. So some would say a death cross means a wider bear market, and a golden cross means a wider bull market. It does mean that a shorter-term moving average has crossed a longer-term moving average, and we know that means something, and people trade on that, and we can trade on that. But there's no guarantee like, oh, okay, things are going to get bad or things are going to get really good, depending on your point of view. If we looked at it graphically, by the way, this is what it would be, right? You get your 200-day moving average, and you have your death cross when it goes, below, and you have your golden cross when it goes above, right? So that's kind of how that all kind of works. So it's the same thing. It's just the concept, but again, there's no magical numbers with moving averages, but it can be self-fulfilling as far as in the news media. But one thing with moving averages, to think about is they're really good, powerful indicating tools. And you can use them in different ways. You can use them as a primary indicator. You can use them to confirm another indicator. You can use them when prices cross above and below lines. You can use them when two moving averages cross each other. There are different ways to use them and different ways to incorporate them into our trading strategy. And they're very established, very well known. So that means lots of traders are using them, so it can be a little bit more predictive that way too as well. So use them with other indicators, but moving averages can be a really, really great way to enhance or be a big part of your strategy in terms of technical analysis. Now later, we're going to talk about how to build these strategies and things together and how to pull these different things that you're learning about together into some, coherent strategies and things, and also how to trade around these things as far as, how much money to invest, all that. That's coming up towards the end. But for right now, understand that a moving average is an indicator. It's a tool. It's another tool in your toolbox, and it's a good tool to have, a good tool to use.